Hello everyone, welcome to week 5 of the course and the first part of the week 5 lectures. This week we're going to expand on what we talked about last week in the context of our study of accountability for sustainable business. We're going to look at the rise of responsible investment and its implications for broader issues surrounding organizational accountability. In this particular lecture, I'm going to look at where responsible investment has come from, what it's depicted or defined as, and how the accounting profession to some extent has a role to play in its rise. The nature of responsible investment is defined variously by different groups. One very prominent advocacy group which is linked to universities is the Principles for Responsible Investment group. And that group brings together masses, in fact thousands of corporations worldwide, and gets them to sign up to responsible investment principles in the context of investment strategies that would be undertaken by signed up organizations. It's operated under the auspices of the United Nations Environment Programme's Finance Initiative and the United Nations Global Compact Initiative. Now, the Principles for Responsible Investment have a very broad definition of responsible investment, and they claim that it's an approach to managing assets that sees investors include environmental, social, and governance factors in their decisions about what they're going to invest in, and then the role they play as ongoing owners and creditors. So the idea is that it's an approach to managing assets, that it includes to some extent ESG factors. And the extent to which ESG factors are included will vary among investment managers. And the ideal behind this responsible investment notion, according to the PRI, is to combine better risk management, a notion we're familiar with improved portfolio returns to reflect investor and beneficiary values in an investment strategy. So you look at broader forms of risk, like ESG risks we discussed last week, but you're always aiming to increase your overall portfolio returns. So their definition of responsible investment is not investing in assets with an ESG focus, irrespective of financial returns. It's investing in these particular assets with the aim, if possible, of actually increasing your portfolio returns, your overall returns from your investments. And in doing so, in the investment strategy, you reflect preferences of beneficiaries of the investments, and indeed the investment communities themselves in these particular areas. So the idea being that responsible investment complements traditional financial analysis and portfolio selection techniques. Now, responsible investment generally can be defined in this broad fashion or in a narrower fashion. But this is what the Principles for Responsible Investment define it as. And we'll keep this broader definition in mind throughout this lecture, while later on alluding to narrower definitions as well. As I outlined in last week's lecture, the type of environmental, social, and governance issues that are addressed in these investment strategies, as opposed to the reporting from last week, can involve issues in the environment area like climate change, resource depletion, waste issues, reducing pollution, etc. In the social area, we're talking about issues around human rights, what's called modern slavery, child labour, overall working conditions, and general employee relations. And then in the governance sector, issues around executive pay, bribery and corruption, board diversity, political lobbying and campaigning, etc. And also the tax strategy of companies. So these are all very broad environmental, social and governance issues. In the Dutch context, we have Dutch banks who have very specific investment policies around ESG issues. And when they think of ESG factors, they also try and develop indicators to give them some sense as to how these factors are being addressed by the institutions and companies they invest in. So, for example, in the environmental area, they will look, for example, at climate change and environmental pollution. And for climate change, they will look at measures like carbon intensity, the carbon emissions, etc. of organizations. In terms of environmental pollution, they look at policies countering environmental pollution. In the area of social risks, they look at things like human rights and employment conditions. And in the context of human rights, they look at human rights policies, workforce-related incidence policies, and in employment conditions, incidents in workforces, health and safety issues, deaths, etc. And again, policies to reduce safety incidents. And then thirdly, in the area of governance, they tend to look at corruption and bribery and fraud to see if corruption policies are in place. I'd also look to see what sort of controversies have been associated with companies in their management of certain areas. Now, you'll notice with these indicators over here on the right-hand side, there's a lot of mention of policy. Policy countering environmental pollution, human rights policy, workforce-related incidents policy, corruption policy. And as we know, it's all very well having a policy, but how it's implemented and whether it has any impact is probably the question we'd like to ask. That's something to bear in mind, that the indicators that are used for environmental and social risks are wide, they're varied, they're produced by very different companies and different types of organizations, and they can cause confusion for investment communities trying to invest according to ESG factors. But that's a feature of this broad environment currently. When talking about these ESG risks, many organizations allude to, first of all, broad global type risks. And there's a very commonly used and famous, indeed, landscape of global risks, which is produced by the World Economic Forum, WEF. And they produce every year a global risks landscape. And you can see on this axis here, they talk about the impact of an actual risk, and here the likelihood of that risk occurring. This is a traditional risk map we looked at as part of lecture 3. And up here in the top right hand corner, we can see what they consider to be the risks globally, which have a high impact and also are most likely to occur. So we see failure of climate change mitigation and adaptation here, extreme weather events, natural disasters, cyber attacks, a very topical issue right now, man-made environmental disasters, large-scale involuntary migration, data fraud or theft. These are all broad-scale global risks that they look at, but they have implications for individual organizations as well. And many large organizations will look at these global risks when undertaking the scenario analysis that we talked about last week. So in the context of the global risks landscape, the 5 most likely risks in terms of their analysis are extreme weather events, failure of climate change mitigation and adaptation, natural disasters, data fraud or theft, and cyber attacks. Their top 5 risks in terms of impact: weapons of mass destruction, failure of climate change mitigation and adaptation, extreme weather events, water crises, and natural disasters. These are the type of novel risks. Maybe to some extent they might be black swan events, but not necessarily in some cases. But these are the type of risks that can be reported on and managed using scenario analyses according to the TCFD framework we looked at last week. So that's a broad scoping of risk at a global level. Now, in terms of what we're focusing on today in responsible investment, this whole area has evolved as organizations have had to cope with broadening global risks that impact them, but also have had to cope with increasing demand for this form of investment. And if we look here on this particular depiction, we can see to some extent some of the key issues that motivated or drove the evolution of this responsible investment as defined by the PRI. So in 1971, we had the launch of the Pax World Fund, and that was the first socially responsible mutual fund in the US, whereby money was invested in funds which had ESG criteria at their core. In the 1980s, in the context of the apartheid regime in South Africa, a number of investors and investment funds divested from South Africa to protest against the apartheid policy there. I should point out a number didn't as well. In 1989, there was a major Exxon Valdez oil spill off the US coast. And here, a number of principles were actually set out to actually aid investors who wanted to avoid organizations which might actually be at risk of posing problems for the environment in the context of their health and safety and their environmental protection policies. And then we had the launch of indices, stock market type indices, which just focused on funds and stocks, which were looking at organizations with ESG type issues at their core, or at least to some extent addressed. So in 1990, we had the launch of the Domini 400 Social Index. And that was one of the first of many socially responsible indices that came out. So these are indices which try and allow certain companies who meet certain so-called ESG criteria to become listed on the indices and then traded. In 1998, as alluded to in a week 1 lecture in the Spira and Page paper, the UK published its first corporate governance code, and that code had a broader conception of corporations and corporate governance. And then we had the launch of what's now a very famous sustainability index, the Dow Jones Sustainability Index. It's for short, it's known as the DJSI. It's so well known. And again, companies can list on this index if they meet certain ESG criteria in their corporate governance and in their operations. The Principles for Responsible Investment is the organization I alluded to in the first slide. That was set up in 2006 to bring together companies and investors committed to responsible investment at that very broad level of trying to combine financial return with a concern for ESG factors. The World Bank issued its first green bond in 2008, and that involved issuing a bond designed to fund companies and activities which were aligned with environmental concerns, aligned with solving environmental problems or having a concern for them. And that green bond market, as is alluded to in the lecture paper last week by O'Dwyer and Unerman, has actually exploded in the past 3 to 4 years. Then in 2015, we revisited another friend from last week, the Sustainable Development Goals, which were issued by the United Nations. And again, this was this formally agreed framework with these 17 goals seeking to move society generally worldwide towards a more sustainable type of world. In 2017, the Climate Action 100 Plus group was formed. This was a big investment group, and I referred to it briefly last week, which came together to push for greater consideration of climate impacts in investment funds and among investors. And in 2019, the Principles for Responsible Investment group announced that it now had 2,500 signatories, people signing up to its principles for responsible investment. Now, I should pause here to make it very clear to you what I'm doing in this lecture, and indeed in last week's lecture, is presenting to you issues that are happening in this environment. I'm not proposing or propagating any particular viewpoint on these issues. It's up to you to understand what's going on and make sense of what's going on and make your own analysis of what you think about what's going on. Whether you think it's a positive thing or a negative thing is entirely up to your own individual analysis of what I present to you. Now, the growing demand for responsible investment is, whatever we think about it, unavoidable. Some examples here taken recently from the Financial Times indicate this to you. This is a report just in November this month about Scottish Widows, which is a major pension funds manager in the UK, actually throwing out 440 million pounds sterling of company holdings that failed what they deemed to be environmental, social and governance tests. Here's the quote from the article. Scottish Widows plans to dump company investments worth at least £450 million that fail to meet its environmental, social and governance standards. This is one of the most far-reaching exclusions policies adopted by a major UK pensions provider. And many pension funds, including the very large ABP fund here in the Netherlands, have these sort of ESG or sustainable or responsible investment policies. And this is mentioned to you last week as well. PwC issued a report recently as well stating that these environmental, social and governance funds focused on these factors, were forecast to outnumber conventional funds by 2025. And you'll see here from this quote, assets in sustainable investment products in Europe are expected to rise to over 6.76 trillion euro over the next 5 years and to outnumber conventional funds. These are predictions of trends. These are market demands that are actually occurring right now, whatever you think about them. However, these demands for responsible investment require data. And as we outlined last week, we tend to have what's often called this alphabet soup of ESG reporting standards and frameworks out there, and lots of efforts to try and align them. And to date, somewhat unsuccessfully. And now we have the IFRS Foundation coming in and bringing us accountants into this to play a central role in the development of these reporting frameworks. And this, of course, leads to many of the asset managers worldwide calling for global standardized ESG standards. One example, again, is back to BlackRock, who I mentioned last week. And they have said that they need these global standards to come together in a single framework, because the current proliferation of disclosure initiatives, many of which are overlapping, which we saw last week, has led to duplicative efforts by reporters and a lack of consistent and comparable data. This is a consistent, continual concern among large asset managers who want to move into investing in funds and stocks which conform with certain ESG criteria. To do that, they need information, they need reporting, and they're saying they need reliable and comparable reporting on this. It's a really big issue in this area. I myself know a number of fund managers and fund directors in Dutch investment institutions, and I'm actually surprised myself sometimes at the focus on this responsible investment, in particular because many of these funds see concerns in the future if they don't address issues around ESG, but they also see that these funds can lead to much higher returns in certain circumstances. And again, this comes back on the right-hand side here to this concern from fund managers trying to compare what they call ESG apples and oranges. The idea that you have all of these scoring mechanisms whereby there are a plethora of companies out there now who will say, okay, we score X company as 4 out of 10 on ESG factors. We score Y company as 8 out of 10 on ESG factors. And they all have their own scoring mechanisms. And they're all used then by asset managers to seek to inform their investment decisions in the responsible investment area. But many of these criteria are not comparable. Many of these scoring mechanisms use different bases. So it can create a lot of confusion. So this is a big issue. And the OECD, which released a recent report on responsible investment, is also outlining how this is a big problem. This data problem is crucial in this area. Now, of course, while responsible investment may be a major issue right now and might be receiving a lot of support from investors and from other stakeholders as well, there are a lot of skeptical views out there too. For example, some people feel that much of what's being reported, much of the data, and much of the companies and funds being invested in are really engaging in what they call greenwashing. There's no substance behind what's being reported. There's no substance behind any proclaimed commitment to so-called ESG issues. So this is a report from the Financial Times at the end of last month. Investors probe ESG credentials of bond sellers on greenwashing fears. And this alludes to the green bond market, where bonds are issued which are designed to fund so-called ESG focused companies in stock market indices. And if I just read this quote from the article for you, it says the green bond market has grown from almost nothing a decade ago to roughly 660 billion euro in outstanding debt today, and is forecast to hit 2 trillion euro by the end of 2023, according to research by NN Investment Partners here in the Netherlands this month. But NN Investment Partners also found that 15% of such bonds are issued by companies involved in controversial practices that contravene environmental standards. So the idea being that, yes, these green bonds are issued, but where they're going and where they're being invested is not conforming to the criteria in the bond issues. And then, of course, we have aggressive hedge funds, which have absolutely no time for this responsible investment whatsoever, and no time for companies becoming in any way engaged in assessing ESG risks or engaging in issues around ESG. So this is another report from August this year in the Financial Times, talking about how hedge funds, particular hedge funds as investment groups, they target companies who are investing a little bit in corporate social responsibility. And their philosophy is that CSR, or investments in CSR or ESG factors, are a sign that a company is actually wasting money rather than focusing on shareholder returns. And research undertaken by researchers at Pennsylvania State University and here in the Netherlands by Emilio Barti at Erasmus, and also by Rudolf Durand in HSA in Paris, have found that these hedge fund managers actually will target these organizations as being inefficient and as being not worthy of investment, being worthy of divestment, etc. So that's a very different view on this. Now, a counter view might be that, well, if you're looking at risks, risks will impact on returns. And perhaps then it's a sensible strategy and not an inefficient strategy. But as you can see, the debate can go on and on and on. And of course, you then have others who will counter this view and say, hang on, all these skeptics are out there talking about how stakeholder capitalism, as many people call this trend towards responsible investment, is delivering inadequate returns, is bogus, that this isn't the case. And we'll see some evidence both in support of increased returns from so-called responsible investment and some inconclusive evidence as well from the OECD. And this evidence tends to proliferate depending on the body that is producing it. And you have to be very careful to make sure the bodies producing the evidence are at least somewhat independent. Now, responsible investment is one element of investment focused on social issues. And it's situated in a broader social investment ecosystem. And it's important to make sure we realize what the PRI wants to promote when it's talking about responsible investment. Excuse me. And what I have here on this slide is a spectrum of what's called social and financial investing. And on the left-hand side here, we have pure philanthropic investments, both traditional and venture philanthropy. And those types of investments are focused on social returns, just returns to society and making a broader social impact. So financial returns are not a feature of those, okay? They're not what we're looking at on this course. Then you have what's called social impact investing, which is moving a bit more towards a concern for financial returns. And this is often called social investing. It can also be called impact investment. Now, social investment is investment with a focus on social and or environmental outcomes. And some expected financial return is required. So you have this social return and a financial return required, but the financial return may be sub-market. It mightn't be as good as the return you'll get in the market, but you expect some return. With impact investment, you're looking to have a measurable environmental and or social return. And that actually creates some very interesting measurement issues regarding how you measure and report on impact. And accountants have been very heavily involved in that in the past 15 years. And again, here, it's all about social return, but this time with impact investment, you want an adequate financial return as well. You're looking for a decent financial return that will at least match the market. And you can, of course, you can see there that can create all sorts of tensions between the social and environmental returns. Tensions which to some extent are underpinning elements of the Caldarelli et al. Paper we covered last week in the seminars. But again, with the social impact investing, the social return is important, but there's a financial element to that. Now, with sustainable and responsible investing, what we're really focusing on here today, to a large extent, you're talking about a focus on trying to enhance long-term value by using environmental, social and governance factors to mitigate risks and also to identify growth opportunities. That's to a large extent what the TCFD tries to promote. That's to a large extent what bodies like the Sustainability Accounting Standards Board in the US promote as well. So it's the idea that you're investing for the long term. And by looking and assessing ESG risks and opportunities, you actually are aligning with that long-term focus. So here in this, you have a situation where you're looking for a financial market return focused on long-term value. So you want that financial return. Now, of course, there are some overlaps in many of these areas. But this is the one we're looking at in particular today is this sustainable and responsible investing. You might prefer to look at social impact investing and philanthropy as forms of responsible investment, and that's absolutely fine. But I need to focus us on one area today. And then, of course, over here on the right-hand side, we have conventional financial investing, which is a fully commercial investment with limited or no regard for environmental, social governance practices. You invest, you want a financial return, and that's it. No consideration of anything beyond that. And of course, there can be overlaps between these two as well. So in the overall spectrum or wider ecosystem of social and financial investing, this is where responsible investment, as we largely discuss it today, is situated. Now, in terms of how this demand for responsible investment has actually being translated into investment practice, there are some figures out there which give us an indication as to how ESG factors are driving some investment strategies. Now, this is data from US managed assets, and this is the data is a little bit dated. It's 2017 data, but you'll see here $46.6 trillion were managed by US managed companies at the end of 2017. 12 trillion of that was aligned with investments in assets which had some socially responsible investment indicator, some issue around social responsible investment driving them. So 12 trillion. And that compares to recent figures by the OECD, which suggest there's about 17.5 trillion globally invested in so-called responsible investment funds. Now, you have to be very wary of these figures because the data they're based on comes from so many different sources, and how you define a responsible investment also can vary as well. But if I look over here on the right-hand side, you can see a breakdown between investments where ESG was incorporated by money managers on behalf of individual investors like you maybe or me, retail investors, that was $3 billion, and then money managers investing on behalf of institutional investors like pension funds, etc. 8.6 billion, almost $9 billion. And that gives you an idea as to the demand out there, and you can see most of the demand is coming from the institutional investors, but that may well just reflect the fact they've got more money to invest. And you have overlapping strategies there as well, 1.4 billion. So the point is there's a lot of money getting invested in these so-called responsible investment funds, however they're actually defined. And again, if we just go back for a moment to what's driving all of this, the PRI claim there are three key drivers. First one, materiality. An increasing recognition that ESG factors can affect risk and return, conventional view. Also, demand is coming from clients. Beneficiaries, like investors, like maybe you and me, are looking for greater transparency about where their money is going, where it's invested. And then you also have the creeping effect of regulation, because much more guidance is coming out now from regulators, ensuring that ESG factors are part of what's called an investor's fiduciary duty. And there's a big green fund and green trend in the EU and European Union at the moment, whereby they're bringing out lots of regulations, not just on reporting, but also on investment policies for governments, pension funds, sovereign wealth funds as well, which we'll see coming up in one of the papers this week. So regulation is also emerging in this particular area as well to push investments in a certain direction. And if we then look at surveys of institutional investors as to why they're investing more in so-called responsible investment funds, we see, interestingly enough, from this recent survey that it's all about return. It's nothing to do with issues around concern for environmental and social and governance issues per se. It's about driving returns. So this survey here indicates that institutional investors and asset managers are investing in ESG or in integrating ESG factors into their investment decision-making processes, primarily because they can get improved long-term returns that aligns with the focus of the TCFD, improve brand image and reputation, decrease investment risk. And that comes back to our issue of COSO and assessing ESG risks. Regulation is also becoming an issue. External stakeholder pressure, maybe from beneficiaries and other elements of society, is causing some pressure as well. And then there are a number of new factors, such as attracting new talent like yourselves, altruistic values, and board or activist investor pressure, which are reasonably high up there in the elements of the reasons that are outlined. If I take this then and apply it to Dutch financial institutions and what they say drives their focus on considering sustainability aspects in their investment decisions, they say in most cases it's meeting customers or members' wishes. So they're getting external pressure or membership pressure for this. Also, it's about, one of our key focuses in this course, managing risks related to sustainability or ESG factors. They see risks in the environment, they map the risks, they want to manage them in some way, and so they invest on that basis. There's also a commitment to contributing to sustainability goals to some extent among these institutions. And for some of the institutions too, they may be feeling pressure that might come from regulation in the future. Improving financial returns is also a factor, a key factor, but it's not the crucial factor for them. At least that's what they say to us in the survey that was conducted here by the Dutch Central Bank very recently. But the point here is that the motives for this responsible investment movement can tend to vary. They do tend to be much more about financial returns if you speak to institutional investors, and then it will depend on the sectors you're looking at, the broad types of institutional investors you talk to that actually that will determine the extent to which a motive is driving this form of investment or not. But bear in mind as well, as I mentioned earlier, one of the key issues in this area that causes concern is an absence of data, a real concern about quality of data. And the recent OECD report I keep referring to talks a lot about the reporting frameworks we talked about last week, the lack of alignment, and also how do you score companies and funds on their ESG commitment? How do you get reliable scores or measures for this? Very difficult to do so. So you can find this is causing a lot of concern in the so-called responsible investment marketplace. On the issue of regulation, as you can see here from this particular graph, the number of policy interventions in the past 20 years has just increased phenomenally, so that lots and lots of interventions are coming in to regulate responsible investment. And the PRI states that since the mid-1990s, responsible investment regulation has increased significantly, with a particular surge in policy interventions since the 2008 financial crisis. Regulatory change has also been driven by the realization among national and international regulators that the financial sector can play an important role in meeting global challenges such as climate change, modern slavery, and tax avoidance. So keep in mind again, that's consistent with this market-based approach to looking at these factors, and very consistent too with the rationale and the philosophy behind a reporting framework like the TCFD. And this relates to regulators again coming into this particular area. And again, as we said last week, there are moves afoot in various European contexts to make the TCFD disclosure recommendations a requirement in the next 1 to 2 years. Now, this regulation, which relates specifically to responsible investment, tends to focus on 3 key categories, and these 3 categories reflect the key elements that are embedded in the investment chain. So first of all, asset owners are targeted, and asset owners are usually focused on disclosure requirements for pension funds. So they want pension funds and key other state-owned asset owners to report on their investment policies. And as it says here in the last part of this, prudential regulators are beginning to consider climate risk in the insurance market because it's such a big risk for insurers in terms of the sort of companies they are assuring and insuring for major losses from disasters. So asset owner regulations are quite common around pension funds and also sometimes sovereign wealth funds as well that we deal with in this week's seminar. And then you have stewardship. So you've got stewardship codes between investors and investee companies, and they're designed to encourage better governance and protect shareholders. So companies are required to commit to certain corporate governance standards. And then we have our key issue from last week, corporate disclosure, whereby guidelines have been set up, and they're coming from governments and stock exchanges, and they're encouraging or requiring companies to disclose information on ESG risks and opportunities that are required by investors. And that aligns directly back to last week's lecture when we talked about the evolution of the concern for managing ESG risks and the evolution of all these frameworks which tend to report on these ESG risks. And the idea being disclosure can raise awareness of ESG issues within a company. Now, whether they can or not is mixed in terms of the evidence provided, and then which can lead them to be managed better. These are all very nice aspirations to have, but I would argue myself, from the academic literature at least, there is mixed evidence as to the extent of which requiring disclosure translates to change in policies and practices and management within companies. In the context of regulation, and in particular with respect to listed companies, which of course will be a very key focus for responsible investors, stock exchange guidance has also proliferated in the past. So this is taken again from the PRI body. They say that 12 stock exchanges incorporate ESG disclosure requirements in their listing rules. For example, in Canada recently, the stock exchange there started requiring companies who are listed on that stock exchange to comply to some extent with the TCFD disclosure requirements. So 15 stock exchanges offer guidance to issuers of shares on reporting on ESG related issues, and they say 23 stock exchanges have committed to introducing ESG reporting guidance thanks to a certain initiative they refer to called the Sustainable Stock Exchanges Initiative. And back to last week, what are the reporting frameworks that are referenced in the guidance that's produced by stock exchanges? Well, at the very top, in 91% of these stock exchange ESG guidance documents, the Global Reporting Initiative is mentioned. And remember, that's the initiative of companies on environmental, social, and governance issues. And then the integrated reporting we looked at last week, and in the Humphrey et al. Paper as well, is the second most cited reporting framework that the stock exchange recommend that companies comply with. And even though the TCFD has only been in existence for just over 3 years, stock exchange guidance is now, in 48% of the cases looked at this year by the Sustainable Stock Exchange Initiative survey, 48% of these pieces of guidance refer to compliance with TCFD disclosures. And then the other bodies are mentioned in there as well. But of course, what many would prefer is to have one type of disclosure you need to confirm with. And that's why we have these initiatives like the IFRS Foundation and the World Economic Forum I mentioned last week, trying to come together with more aligned ESG reporting frameworks. Whether they will succeed or not, we'll wait and see. Now, back to the issue earlier on about skepticism around whether these responsible investments actually do offer you superior financial returns. The Principle for Responsible Investment Organization, probably unsurprisingly, indicates that out of 2,000 studies since 1970, 63% have found a positive link between a company's ESG performance, as measured in some way, and its financial performance, and only 10% have found a negative link. So they state that an analysis of over 2,000 academic studies on how ESG factors affect corporate financial performance found, to quote them, an overwhelming share of positive results, with just 1 in 10 showing a negative relationship. So this is, again, probably unsurprising in terms of the communication, because the PRI is a broad body which brings together huge amounts of companies to commit to responsible investment. But again, they are promoting this not because responsible investment is leading to better practices, but because responsible investment is leading to better financial returns. And that's important for them, because they're trying to make it very clear we are about showing you how investing responsibly makes sense from an economic perspective. Don't think you're going to suffer in some way. It's not responsible investment is not, as you'll see later on, for them, social impact investing. It's not philanthropy. It's a form of investment that will provide you with, on average, superior financial returns. That's a big claim, but it's the way they present responsible investment in this organization. But then, in my research, because I like to look for alternative viewpoints everywhere, if I go to the recent OECD report on responsible investment performance, and this is a report which is up on the Canvas site for you, it's not required reading, but for any of you who want to delve into these issues just in a little bit more detail, the executive summary in that report is a wonderful summary of the current state of play in responsible investment and in this overall realm whereby organizations are being asked to account more broadly. But that report says the following in part of its conclusions based on its research. They found little differentiation in the performance of funds with higher scoring and lower scoring ESG securities, shares. So for them, in the studies they did, they looked at funds who were scored high on a commitment to ESG factors and studies for scored low. And they didn't see much differentiation in their financial performance. And they found a wide range of performance of funds across both categories. So some ESG responsible investment funds performed extremely well, some performed extremely poorly, and the same for those who are low on ESG scoring. And so this wide range of performance, they say, indicates that a host of other factors, including particular investment strategies and their implementation, drive results. So it's not as clear-cut as might be implied from my previous slide. They go on to state, this result simply indicates that investors should not generalize about the potential financial returns of funds based on ESG scores. Okay, so be wary about generalizing. But everybody, for you and for me as well, be aware this term here, ESG scores, because there's a proliferation, a mountain of bodies and organizations out there offering to sell you scores of companies, scores of investment funds based on ESG factors. It is a literal industry and a very, very lucrative industry. And those scores determine how you will rank a fund or even rank an individual company. That's quite important in the context of this week's lecture paper coming up in the second part of this lecture. But those scores can vary depending on funds, so one needs to be wary about that as well. But the key thing they say then is there is no evidence that a preference for high ESG funds leads to underperformance. But there's also no clear evidence for them, at least, that it leads to overperformance. So don't think that because you invest based on ESG scores, you're going to get higher financial returns. That's the essence of what they find. There's also resistance to pushing companies to engage in more concern around ESG factors too, because of the fiduciary duties that companies are deemed to have to their shareholders and beneficiaries. And this is also an issue in particular for investment funds, whereby they're being told you have a fiduciary duty to the individuals and companies who invest with you and ask you to invest on their behalf. That fiduciary duty, in other words, that duty to act on their behalf in their best interests, is all about gaining the maximum financial returns for them. So if that's your obligation, then you as an investor should interpret this as a reason not to incorporate ESG issues in your investment decision making. Okay? You shouldn't, because if you do that, you may well be pushing your investments in a direction that leads to lower financial returns. We don't have clear evidence on this, but this is what actually happens in practice sometimes. So ESG factors in this case here are not seen as financial factors. They're not seen as something that should be taken into account. The point being, you look after your investors, you get the highest financial returns you possibly can, irrespective of ESG issues. Now, the PRI has a problem with this, and they did some research on this, and they came back and said, hang on a second, we can argue that your fiduciary duty as an investor does require you to consider looking at ESG factors in the investment decisions you make. And they say that in certain instances, financially material ESG factors must be incorporated into investment decision making. Now, bear in mind, they note the word financially material here. And what do they say then? They say investors should consider ESG factors consistent with the time frame of the obligation. So if it's a longer term obligation, like with a pension fund, ESG factors have to be considered. It's unavoidable you have to consider climate change risks. It's unavoidable you have to consider maybe some of those global risks outlined by the World Economic Forum, and also risks which are specific to your organization that might have environmental and social implications. So in this case, the PRI argue investors should understand and incorporate the ESG preferences of their clients and their beneficiaries. That's a bit different from saying they must be incorporated into it, because the preferences of the client and of the beneficiary might be not to incorporate these factors. Okay, so you have these diverging viewpoints around whether they should be incorporated or not. But in the context of the responsible investment conception that we look at in this particular lecture, ESG factors are incorporated into investment decisions. The final point on this slide just mentions that the PRI feels that investors should disclose the process they follow when incorporating these ESG factors. Now, I'm going to end the lecture by looking at some claimed misconceptions about responsible investment which the PRI outline. And the first one indicates that many people believe that responsible investment involves investing in a specific investment strategy or in a specific investment product. And they say responsible investment does not necessarily require investing in a specific strategy or product. It simply involves including ESG information in investment decision making, making sure you ensure that all relevant factors are accounted for when assessing risk and return. Exactly how an investor practices responsible investment varies widely. And that was my point about situating responsible investment or ESG investing in that broader schema of social investment, whereby the PRI wants to make it very clear that responsible investment, it's a broad club, okay? It doesn't have to be one product, doesn't have to be one strategy. You're just including ESG information in your investment decision process. However you do that is up to you. And what you're trying to do is ensure you are, when trying to work out your risk versus your returns, incorporating all relevant factors in that assessment. So it's a very, very broad definition that they come up with in trying to encourage responsible investment. The second misconception they claim, and this relates back to the argument or point I was making earlier on about the relationship between responsible investment and returns. They say there's a misconception that if you go and invest on a responsible basis, you're going to have lower investment returns. They say that responsible investment does not require sacrificing returns. It should in fact enhance risk and return characteristics by incorporating more factors into your deliberations as an investor. Investors apply a range of techniques to identify risks and opportunities that might remain undiscovered without the analysis of specific ESG data and broad ESG trends. Now, of course, as I showed you earlier, they also make the case in their documentation that research shows that on average, responsible investment leads to higher financial returns, but the OECD would counter that with their research. And then the third misconception about responsible investment, despite me having two set up here on my headline, it is the same as sustainable, ethical, socially responsible, and impact investing. And again, this comes back to me trying to show you where ESG or responsible investing, as we outline it here, is positioned in that broader social investment arena. And they say there are many terms associated with the plethora of investment approaches that consider environmental, social, and governance issues. Most lack formal definitions, and they are often used interchangeably. A key to understanding how responsible investment is broader than these concepts is that where many make moral or ethical goals a primary purpose of their investment decision, responsible investment, as outlined by the PRI, can and should also be pursued by the investor whose sole focus is financial performance. So the idea being that if you are solely focused on getting financial returns, you can also follow a responsible investment strategy. And that's the key thing they want to get across, because they are a conventional mainstream organization bringing in the mainstream investment community into this responsible investment realm. So my final point then is to try and locate to some extent us in the middle of all of this. The theme of this week's lectures is this broadening of organizational accountability, which is being driven now somewhat by responsible investors and the growth in the responsible investment market, because that leads companies to feel they have to act and report on ESG related factors relating to their governance and their management of their organizations. In terms of accounting, you'd be very surprised to know that many major accounting bodies, particularly in Europe, have been actual leaders in the areas of the broadening out of organizational accountability and reporting on that, and also developing systems to support that reporting in the past 20 years. Accountancy Europe, which is formerly known as the Federation of European Accountants, has actually led the way in this area for years. You'll see here they claim in their, this is from their website, they've got 20 years of experience supporting sustainable financial growth. And they say, we have continuously advocated financing sustainable growth and supported long-term investments for the past 2 decades. Next to our recent publication, Sustainable Finance, which they brought out recently, The accountancy profession's contributions to EU strategy and our contributions on the Capital Markets Union, we have worked extensively on the following topics. So they've been involved in producing information on and contributions to what's called sustainable finance, which is a massive movement right now at the regulatory level in Europe. And they've contributed to all of these developments, to EU strategy in these areas. And of course, as well, they've been heavily involved in developing and promoting reporting non-financial information. Also, improving sustainability disclosures generally. They've done huge work in this area. They've also done a massive work on assurance on non-financial information. And I haven't dealt with assurance in this area on this course. It's an area I've researched quite a lot myself, and I don't do that because I want to keep things at least somewhat focused. But they've done huge work in this area. And they've also, as we said last week, been stimulating integrated reporting quite actively. And there are other areas here that you could talk about as well, how they've looked at how you can embed sustainability in corporate governance and issues around fighting fraud and corruption and tax transparency. So Accountancy Europe is an example of one organisation that has embedded the accountant and the accountant's role in this broader organisational accountability trend, which has partially been driven by this rise in a concern for so-called responsible investment. And you can see over here, they also talk about how accountants can contribute via their daily work to this particular broadening of accountability and this responsible investment response. So they talk about, again, how they're involved in day-to-day activities in corporate reporting, defining models, approaches, and boundaries. Also in corporate governance in organizations as well, developing systems, controls, and processes. And also in what I'm about to mention, the area of audit. And I mentioned this last week as well. Here in the Netherlands, the accountancy profession has been absolutely central in many of these developments in Europe. And as I mentioned also last week, in the area of assurance, in my view, the leaders in that area came here from the Netherlands, from both the big four firms and from consulting firms, which later were subsumed within both firms in this particular context. So that concludes then my first part of this week's lecture, looking again at our theme of this sustainable organizational accountability. And my focus on accountability for sustainable business in this lecture has really just been about this responsible investment movement, because that is driving part of this concern for broader business accountability. And I'm trying to give you some information and some depth about what's happening in this context. You could design 4 or 5 courses on this. There's so much happening in this arena currently. Now, what I'm going to do in part 2 of the lecture, in the lecture paper, is look at a case study of how responsible investment and reporting by companies in response to pressure for greater responsible investment evolved in the Netherlands over a long period from 1995. Through the organization or the coming together of a set of actors in the finance community, but also outside the finance community, which put together benchmarks which would assess companies on ESG factors, which would improve companies' reporting on ESG factors, and which would enable and stimulate responsible investment in this context. And that paper we're going to study in the second part of this week's lecture.